Good afternoon. I'm Simone Cavallaro, Director of the Stigler Center. Today, we're happy to host Professor Thomas Piketty and Robert Topel for a conversation moderated by Ed Luce on Professor Piketty's new book, Capital and Ideology, and COVID-19 and the implication for inequality and capitalism. The new book is available for purchase from the Seminary Co-op. Please see the event description for link and more information. Before we begin, please note, we are on the record and live streaming to the Stigler Center YouTube channel. If you have any questions for the speakers, we will address them in the last 15 minutes. So you can submit them via the Q&A icon at the bottom of your screen. As usual, views expressed by our guests are their own, not those of the Stigler Center or the University of Chicago. We hope you will join us for more upcoming webinars, so please check out our website, our podcast Capital Isn't, and promarket.org, the Stigler Center's publication, which was just redesigned last week. Back to this afternoon. Please allow me to introduce our speakers. Thomas Piketty is a professor at the Paris School of Economics and Director of Studies at EHESS. He is also co-director of the World Inequality Lab and the World Inequality Database, and one of the initiators of the Manifesto for the Democratization of Europe. He has done major work on the interplay between economic development, the distribution of income and wealth, and political conflict. And he's the author of the international bestseller, Capital in the 21st Century, among others. Robert Topel is the Isidore and Gladys Brown Distinguished Service Professor of Economics at Booth. He is also the co-director of the Energy Policy Institute at the University of Chicago. His research areas include labor, health and energy economics, industrial organization, and antitrust, business strategy, and public policy, among others. He has held visiting and research positions at the Federal Reserve, the World Bank, Rand Corporation, and more. Our moderator today is Ed Luce, the Financial Times U.S. National Editor and columnist. Previously, he was the FT's Washington Bureau Chief, and before that, the speechwriter for Treasury Secretary Larry Summers in the Clinton administration. He is also author of 3 highly acclaimed books and appears frequently in the media. And now, without further ado, I turn it over to our speakers. Thank you.
Thank you very much, Simone. It's a real pleasure to be at the Stigler Center, at least virtually. I was greatly looking forward to coming and attending your conference physically, but hopefully next year. This is a hugely important and very topical subject that we're going to be discussing today around capital and ideology, Thomas Piketty's new book, but of course in the context of COVID-19 and all the expected and already visible impacts of this pandemic on inequality in our societies. So I think what we're going to do is ask each in turn of Thomas and then Robert just to talk for 5 minutes, Thomas to outline capital and ideology, and Robert to respond, and then we'll get into questions, about 35 minutes of questions, and I'll leave about a quarter of an hour for Q&A from the audience, which I'll pick up on the screen. So Thomas, congrats on your book, and let's start with you.
Okay, well, thanks a lot for inviting me. You know, of course, I would have much preferred to be here in Chicago to have this debate, but you know, let's do what we can in the current circumstances. So I'm supposed to try to summarize a book of over 1,000 pages in 5 minutes, which, you know, of course, is not completely obvious, but let me show you a few slides. I don't know if you can see them, where, you know, I try to summarize what I do in this book. So, you know, in this talk, you know, I'm not really going to present some of the figures and tables of this book. Let me simply say that, you know, this book, first of all, you know, I'm sorry it's a bit long. Some people don't like very long books, but, you know, I think it's very readable. It can be read by anyone interested in the history of human societies. This is, again, a book about the history of inequality over time and across societies. As compared to my previous book, Capital in the 21st Century, well, first, I think it's much better. It's, you know, my previous book had many limitations. This one certainly has many limitations as well, but you know, I think I'm making progress, in particular in 2 directions. So my previous book was too much Western-centered, and this one devotes a lot more attention than the previous one on outside the West, basically. So I'm looking at India, looking at China, looking at colonialism and its impact on global inequality structure, looking at Brazil, South Africa, Haiti. So taking a much broader perspective than just Western Europe and North America, which was sort of very much the center of my previous book. And also the other major difference is that this new book puts emphasis on ideology and change in political beliefs about inequality and about how to organize the economy as the really key driving force behind changes in inequality. So the key message and takeaway of the book is really to stress that for a given level of economic development and technological development, there are always many different ways to organize society, to organize the economy, and the level and the structure of inequality in a given society is primarily determined by political and ideological choices. And I try to revisit the history of inequality through this perspective. So let me describe very quickly, the contents of the book, so that if you never have a chance to open the book, at least you have a chance to see a little bit the organization of the book. The book is more or less chronological. It starts with what I describe as ternary societies or trifunctional societies, that were societies organized typically with a nobility in charge of law and order, a clerical class in charge of spiritual guidance, education, and to some extent health as well, and a third estate, a third group in societies that was in particular providing raw labor. And in the first part of the book, I describe the transformation from this kind of societies to what I describe as ownership societies in the 19th century, in particular with the case of the French Revolution in France, but I also look at other European trajectories, and of course to the US case, with the particular dimension of course slavery playing a specifically important role in the case of the US. But just staying in the Europe for a minute, I show how at the same time you have an attempt to develop more equal rights, in particular in terms of rights in access to property, independently of your former status or whether you belong to the nobility or not. But on the other hand, there's actually very limited access in terms of effective access to property rights in the 19th century. And you have, if anything, very large and to some extent even growing concentration of wealth during the 19th century in European societies, pretty much until World War I. And I try to study how it's as if you have a sort of new religion about property in the 19th century, a quasi-sacralization of property, which I illustrate in particular with the case of at the time of the abolition of slavery and more generally in all the colonial accumulation of wealth and power. But at the time of the abolition of slavery, there is a full compensation toward slave owners rather than a compensation to slaves, largely because there's a fear, at the time, that if you start questioning this particular kind of property rights, then you will end up with questioning the entire system of property, and so this prevents these societies from doing compensation to slaves or not compensating slave owners, but it also prevents these societies from trying to develop progressive taxation and redistribution of wealth. Things start to change at the beginning of the 19th century and early 20th century. I stress the importance of slave and colonial societies in this overall evolution. So part 2 is very much about slave societies, abolition of slaveries, and also colonialism, where you have a lasting impact on the overall structure of inequality. The case of India is particularly emblematic because the way, in particular, British colonialism contributed to give a specific meaning to the caste categories through the colonial censuses, and this is something that still has a huge impact in the inequality structure in India today. And over and beyond the case of India, you have forced labor in West Africa, in French colonies until pretty much after World War II. So this is, of course, something that has a very lasting impact on inequality structure. Then part 3 and part 4 of the book look more at the 20th century and the beginning of the 21st century. So part 3 of the book is about this huge reduction of inequalities that happened during the 20th century, which I really stress that, in the book, I should say, as tries to have a very sort of optimistic flavor, in particular about the long run evolution. I stress that in the long run, you have a process of reduction of inequality, in particular since the end of the 19th century and the beginning of the 20th century. And even though there's been an increase in inequality in recent decades, you have a long run evolution toward more equality, in particular more equal access to education, which has been very positive, both in terms of equality, mobility, and also economic growth and economic prosperity. So I look at this in part 3 of the book, and in part 4 of the book, I look at somehow what were the main limitations of social democratic societies starting in the 1980s, 1990s, how the electoral coalition that was built in after World War II around social democratic parties, broadly speaking, eroded gradually, and how these parties sort of became what I call in the book the Brahmin left parties, by which I mean that they have, they used to attract relatively lower class, lower educated, lower income voters in the 50s, 60s, 70s, and gradually, they have left support from these voters, and they have become mostly voters of the most highly educated group, which I try to account in a fairly detailed manner in the book, comparing many countries. This is an issue on which a lot has been written, but very often we tend to concentrate only on the US or only on Europe or only, and I think it's really important to look at this in a broader perspective. And basically, I argue that it's mostly the fact that in terms of education policy in particular, and more generally in terms of economic policy and how you deal with globalization, these parties sort of abandon the kind of ambitious redistributive perspectives that they had in the 3 or 4 decades after World War II. And then, I describe new elements for what I call participatory socialism in the 21st century, which some people will prefer to call social democracy. Be aware of the fact that in many countries, social democratic parties and socialist parties are synonymous. It may not be the case in the US, so you can choose your own words if you prefer. But what matters, I think, is to push, again, this agenda based on educational equality and about the sort of rebalancing of property rights with the rights of workers, the rights of consumers, the right of local government, and a more equal distribution of wealth and economic power, which has been, again, a big success in the 20th century. So, I'm not going to go any further. If you go to this website, pkt.psc.ens.fr/ideology, you will find the full slides presentation. There are 50 slides, 60 slides. There's also a version with 200 slides, if you want to see all the 169 figures and tables that are in the book. It's a very data-intensive book. There's, I'm not going to try showing you any data, but if there is a specific question that calls for a particular, data answer, I will show one of the slides. I guess I have already talked for too long, so but if you want to give me 1 or 2 more minutes, I can use it. But maybe it's better if I stop.
Not right now. Yeah, but since it is a 1,200-page book, I will forgive you for going double over length. That was 10 minutes, but I can understand why. Thank you for that summary of your book. Robert, you haven't just brought out a 1,200-page book, but you are responding to one. But do nevertheless try and keep your response to Thomas to 5 minutes.
I'll do my best. Let's
Thank
get myself shared here. All right, so I assume you guys can see that screen now?
Yes.
Yeah.
Okay, well, thanks for having me. And Tomas's book is extremely interesting and very long. So let me make sure, and now here, there we go. So the central idea of the book is that inequality has been rising, and in Tomas's view, and in that of many others, that's not a good thing. He views that inequality, though, it's not economic or technological, it's ideological and political, and that's exactly the way he phrases it. So the book is allegedly, in fact, is built on a sequence of facts, though I find those facts to be fairly incomplete and in many ways misleading. His facts are that within country inequality has risen virtually worldwide. And the main culprit is declining progressivity in tax regimes, that the tax rates on the very rich are too low. And when that's combined with a form of market economy that he calls hyper-capitalism, bad things ensue. So in his view, market forces, I want to be careful about saying his view. What comes through in the book, market forces played a minor role, if any, in the evolution of inequality. His view is that high marginal rates don't hamper growth. And repeatedly through the book, he refers back to a sort of golden age, if you will, of the 1950s and 1960s, where at least the statutory rates in the United States and Great Britain were very high. You all remember the Beatles song about the tax man. Yet economic growth was allegedly higher than it is today. So I just, as I noted in that bullet point there, I just saved you 1,000 interesting but somewhat misleading pages. His new solution, or his solution, is a new brand of socialism with highly progressive taxes, taxes on wealth that transcends the nation state. Countries that fail to participate are going to face extreme sanctions, and that's how it's all going to work. Your taxes are going to be determined not just within the polity within which you live, but by a collection of such polities. So here's some basic facts that I think are important to understand about the operation of so-called hypercapitalism after 1970. First, worldwide inequality declined due to markets and economic development. Second, worldwide poverty declined dramatically. Billions of people escaped extreme poverty. It's lower than at any point in recorded human history, and health greatly improved around the world. As the president of the World Bank said, it's one of the greatest human achievements of our time. In the US and other developed countries, inequality between men and women steadily declined. Pre-tax income and wealth inequality steadily increased. That's the main theme of this book. But post-tax and transfer income and consumption inequality actually rose by much less. Now, those facts aren't due to ideology or the failure of a tax system to tax very high incomes. I'm going to argue that they're driven by technology and market forces that favored highly skilled people relative to less skilled people. And the supply of skills, for a variety of institutional reasons that create the problem, have not kept pace. So the high marginal rates of the 50s and 60s were in fact a chimera. The rich didn't pay them, and the government didn't collect more revenue in those days. It was about 7.5% in the United States. 7.5% of revenue came from personal taxation in the 50s and 60s, and 7.5% was collected in the 80s and 90s. The high growth that occurred in that period was due to other factors, such as recovery from World War II, and a lot of people's capital stocks had been destroyed. So the basic question is this: is rising income inequality due to reduced taxation of the super rich, which is a central theme of this book, And I would say that to propose a solution to the problem of rising inequality, you have to understand the problem in the first place. So my first point is, I'm going to have the same thing 3 times. It ain't taxes. Ain't is a word taken from the French, which means in many ways, it ain't so. Supply and demand, the rising returns to education. Let's take a look at what happened to the returns to education in the United States, but I could show this in a number of Western countries. So if this graph shows you the evolution of the ratio of college graduates, people with 16 years of education, and postgraduate degrees, more than 16 years of education, over from 1963 up until our data ended in 2012. And the thing you notice is that the returns to education went way up. So we're not talking about people at the very top of the wage distribution or the income distribution or the wealth distribution. We're talking about people like most of the people watching this show that are college graduates or people with postgraduate degrees. And you'll notice that, relative to where they were in 1980, coincidentally, right about the time that I entered the labor market as a young assistant professor, the returns to education went way up. In fact, they roughly doubled over time for both college graduates and for people with postgraduate degrees. And I indexed them to 1979 just to demonstrate that point, that the evolution of the returns to education compared to a high school graduate have steadily increased over time. And it's a pretty dramatic increase. The premium roughly doubled for all of them. And a doubling of the returns to an investment like education, an investment in human capital, is a big deal. Now, you'd expect that when the returns went up, people tried to invest and get the thing that's become more valuable, in this case, a college degree. And if you follow cohorts over time in the United States, where a cohort means a high school cohort at age 18, and ask what fraction of them have at least 1 year of schooling, well, it looks like they're responding to incentives. The returns went up and more people went on to get at least 1 year of college. So it looks like it's kind of good news that the supply of human capital is going to keep up with the rising demand as measured by the returns. However, this graph shows you what's happened over the entire century from 1920 up until roughly today. And you'll note that for men with 4 years who have graduated from college, and this is done again by cohort, that fraction of each population, fraction of the population of each cohort was rising steadily over time until around the mid 1960s and 70s. Then it dipped, which is reflective of coming out of the Vietnam War. But the main point is it stalled after 1980. It stalled around 30% of the population of young men in the United States. Whereas women have continued to have increasing education. A larger fraction of women, in fact, complete 4 years of college than men. But the point there is that supply did not keep up with the rising demand, and that's why the price went up. And that's why so many of us who are fortunate to be in the class of educated people earn so much more than we did in the past. Now, the second part of this argument, that it's the market, is that this rise in inequality didn't just happen for college graduates and people with postgraduate degrees, and it didn't happen for people just at the top of the wage distribution. This shows average weekly wages by percentiles of the wage distribution from 1963 up until the mid 2000s and mid 2010s. And you'll notice that the most rapid growth was at the top. And if I'd been able to show you the 99th percentile and the 99.9th percentile, they would be going way up as well. So the point there is that at the bottom of the wage distribution, there's been very little real earnings growth, real wage growth at all. But at the top, there's been quite a bit. That's rising inequality. But it's not a return to people at the very top. It's not the Jeff Bezoses and stuff. They've all prospered. They've gotten super rich, it's true, but this is something that's going on throughout the wage distribution. Another way of looking at that is this. This shows wage growth over the period from 1973 up into 1970 to 72 up to 2012 by percentiles of the wage distribution. And to simplify, though, there are some wiggles in there. Every percentile of the wage distribution, of the skill distribution, think of it that way, did better in terms of wage growth than the percentile below it. It's a steady increase across the wage distribution. So most wage growth took place at the top. The more skilled, the rich, if you will, got richer, and the people at the bottom did not. The other point to notice, though, is that throughout, at every percentile of the wage distribution for women, women's wages grew faster than for men. So that's the point I made earlier about convergence of earnings and earning power of women relative to men. Inequalities increased for both groups throughout the wage distribution. It's not simply a story of the top. The 40th percentile did better than the 35th percentile. The 35th percentile did better than the 30th, and so on. It's market forces that are behind this. And just to emphasize the point.
Robert, we're getting way over length here. Could you finish up, please?
Yeah. Just to emphasize the point, as earning power went up, as wages rose, the people who end up working more at the top of the wage distribution were the returns to work. And I'll just show the point of the last slide. The same market forces affect superstars, the top 1%, and you and me. It's not something that's just concentrated at the top. And I give some examples here of the superstar earnings that have occurred. For example, if you look at professional soccer, which will make it more accessible to everybody who's a European listening in 1970, Pele made $144,000, or a little less than $1 million. Today, Lionel Messi makes 127 million, which is 135 times in real terms what Pele was making, for a annual growth rate of 10.5%. That's huge. And that was driven by technology and a change in market circumstances, not a change in the tax system.
Okay, thank you. I'm going to ask each of you some questions. Since you've both ruthlessly ignored my 5-minute time limit, I'm going to ruthlessly interrupt where necessary from now on. Thomas, thank you for your presentation. Let me just start by asking you one question about the sort of foundation of it, ideology, capital and ideology. Your thesis is what Paul Krugman said in his review of your book, is basically Marx turned on its head. Marx said that technology and economic structure determines the ideology. You're saying ideology determines the economic structure and technology. And just picking up from what Robert was just talking about, the superstar effect, the winner takes all phenomenon that we've been seeing in recent years, and which is increasing on steroids during COVID. Surely that's technology that's having an impact on a direct primal impact on the distribution of wealth. And surely there are other factors like market concentration, like the lack of antitrust action, or indeed trade, that are just as important as ideology. Could you answer that sort of Krugman criticism?
Yeah, well, first of all, let me say very clearly to Robert that, I fully agree that education and, supply of education and demand of education is very important, and it plays a huge role in my book. I'm really sorry if you did not see that, I'm sorry that my book is so long, but, it plays a very big role. But calling this market forces, I think is another issue. I think the educational system and the political choices we make about how we organize our educational system, our legal system, our antitrust policies. I mean, this is absolutely critical. And again, I have nothing against everything you've shown about wages and education premium. That's perfectly fine. I know this very well, no problem at all. But here you're looking at a very small angle of the much bigger picture that I look at, over a much longer period of time, and where you see huge transformation, in particular of the educational system. So let me remind you, the US as a country, was an economic leader during most of the 20th century, largely because it was an educational leader. So, in the middle of the 20th century, indeed, you had, 90% of the generation in the US going to high school at a time when it was 20 or 30% in Western Europe and Japan. Now, this educational leadership has ceased since the 1980s. And if we want to understand first why there was this educational leadership to begin with, and why it ended, you obviously have to look about, all the, the ideology, generally speaking, the politics of education, and that's what I'm talking about, is that all these institutions, they are man-made, they depend on different belief system about what we should do with, in this case, with the education system. So, let me maybe stress, just to stress the role of policy and change. If I don't know if you can see, just to try to have a dialogue a little bit with Robert, because again, everything you've shown, Robert, I don't see any disagreement with you. Let me simply say, education. If you look first, if you look at effective tax rate in the US, okay, so these are, effective tax rate, because you mentioned something which was that there was no more tax progressivity in the US in the middle of the 20th century than what there is now. This is not quite right. I think this graph, which takes into account the entire tax system, not only the income tax, but the full tax system in the US, is pretty clear on the fact that there was a time of very strong effective tax progressivity. So this is not statutory tax rate, okay? These are effective tax rate. So I think, that's important. If you have other alternative series to this, you should put them online. But for the time being, this is what we have. And, it's clear that there was a big tax progressivity. Now, regarding the growth rate, coming back to this issue, I just want to draw your attention to this graph. So you said, Robert, that the very high growth rate of the 1950-1990 period was due to a sort of post-World War II effect. I really want to stress that this is not quite right. That, if you look at the previous period, 1910-1950, or even the previous period, 1870-1910, you have roughly the same growth rate for national income per capita in the US, about 2%. So, it was a bit more than 2%, 1950 to 1990. It was a bit less than 2%, 1870, 1910. So it increased a little bit. But, what's really striking is the fact that 1990, 2020, it was only 1.1%. And that's very striking, especially, as compared to the claims that were made in the 1980s. And these were, ideological claim, in the sense that this was a statement by Ronald Reagan that you will boost economic growth and innovation by lowering top income tax rate, which could have been right. From a theoretical perspective, all ideologies are potentially plausible. But the thing is that, the growth rate was divided by 2. And when you compare such long period of time, so, by the way, I'm not saying that the growth rate was divided by 2. Why? Because the top marginal tax rate was also divided by 2. I think it's not. I think again the main reason for that is probably the stagnation of educational investment, which in the end is quite close to what you were describing. The fact that there's been a stagnation in a fraction of a generation going to college, especially for a young male. So, this is all about the US, and of course, the US is a very interesting country, but it's only 5% of the world. And in the book, I try also to talk about how the inequality structure has changed in Sweden, in India, in China. And again, if you want to account for this whole diversity of experiences across the world, across histories, and if you just come with market forces, technology, you're not going to go very far, because all these countries, have adopted such different sets of policies and institutions over time, which in the end are the primary determinant for all this change in inequality, for good and bad reason. If you want to understand this change, you really have to look at politics, ideology, institutional change. So that's the general point I make. And I think this is true today. you're not going to account for why Russian oligarchs today are very rich as compared to 30 years ago when there was no Russian oligarch in Soviet times, just by technology and, the superstar and the productivity of Russian oligarchs, which I'm not sure is so high. So I think change in ideology and change in the legal system are going to be very important, just to take this example to understand why things have changed the way they did in recent decades.
Robert, rather than have you give a long reply to that, you can maybe fold it into the answer to my question. Is COVID-19 going to have an impact on inequality?
Well, yes. I mean, one of the things that is saddest about the impact of COVID-19 is that people like you and me and everybody else's picture that I see at the top of the screen and the people listening in can do much of what they do from comfortable isolation because of the nature of our jobs. Whereas people who are farther down the income distribution, who have different types of jobs, those jobs are disproportionately involved interacting with other people on the factory floor or providing services in a store and things like that. And many of those people are going to lose their jobs, not just temporarily, but permanently. And when businesses close down, one of the tragedies is that people have built up a lot of what economists would call specific human capital, or skills that are specific to the particular occupation or business they work in. And on average, when those people are displaced from those jobs, you would think they go out, take a wage cut for a while, and then bounce right back, but they don't. If they've been in those jobs for a long time, say over 10 years, they lose about 1/3 of their earning power. And that's a major impact that I don't think people are paying enough attention to in this crisis. So it's going to have a disproportionate impact farther down the earnings distribution, farther down the skill distribution.
So for both of you, I mean, are there features of this pandemic and the unique sort of economic situation it's forced us into, are the features of this pandemic that should make us look at policies like universal basic income or government guaranteed jobs, stuff that we might not have even contemplated 6 months ago, that would be appropriate in these circumstances, bearing in mind that Jay Powell himself, a Republican appointed chairman of the Fed, has said that heaviest burden falls on those who are least able to bear it. He said that this weekend. And that 42% of those who've lost their jobs, in America that is, I think the numbers are probably a little bit different in the Eurozone, but 42% of those who've lost their jobs are not likely to get them back. Should we be thinking out of the box? To each of you, this question.
Well, what I see in history is that, this kind of crisis typically can lead to big change in the dominant discourse and ideology about, the legitimacy, well, certainly of public hospitals, public health system. And, I think in many countries and hopefully in the US as well, it will change the belief system about universal healthcare, investing in health, and certainly about income support system as well, which you just mentioned. And I think in particular, we realize, including in rich countries where we have pretty sophisticated system of income support, that you have big part of the labor force that are not adequately covered by unemployment benefit. Lots of temporary workers, self-employed workers, which we have encouraged a lot in recent decades, and which now have no support and have to go and work in the street and at every risk. Now, if we look at the southern hemisphere, it's even more critical. And I think lockdown in India or in West Africa, when 90% of the workers are informal and have no income support, is something that is not going to work and that is not working. And this, we'll see, but it could be, in some countries, it could accelerate the development of a sort of safety net system. And, in the case of India, there was actually a long discussion last year during the electoral campaign with the Congress party and also lower caste party to introduce a very basic income scheme. And 6 months before the election, it looked as if it could have won the election. Then you had the Kashmir terrorist attack, and Modi was able to reframe the election in terms of Hindu-Muslim identity-based conflict, and this was all gone. But we'll see. What I see in history in my work is that often, governments then don't plan to do these things, because of the extreme circumstances they are put into, change their ideology, in effect, in order to adapt to new challenges and do things that they would never have thought of doing. Public debt is going to be another big issue. What do we do with public debt? And again, there are lots of examples in history of you have lots of surprise in history on how governments imagine new ways to deal with large public debt.
I think the sort of key message the markets took from Jay Powell was that debt is the last of our concerns right now. Is that correct, Robert? And do radical times call for radical measures?
Well, large catastrophes call for larger measures. I don't know if I'd call them radical. The great economist Joseph Schumpeter, he of destruction. Now, this is destruction, but it's not very creative. We see a lot of people being put out of work, and their livelihoods, as I mentioned a bit ago, are going to be severely damaged. And what Schumpeter said in that context was, we have to suffer the consequences. We have to suffer the defeat in some sense, but at least we can order up an ordered retreat, which is to say that the circumstances here probably warrant greater income transfers to certain people under certain circumstances. But one has to be wary of the tendency, as some on the left has sometimes called it, never waste a crisis, in order to expand it into the types of policies that they'd like to have for the long run. This is not a long run problem. This is an immediate problem that requires a level of social insurance. And I think the institutions that we have are capable of providing it without transforming society in some way because of a crisis that occurs a couple of times per century.
Okay, let me ask each of you, because this is the Stigler Center and the annual conference was going to physically have taken place, about competition, looking not just at the US economy and at the growth in concentration that we've seen across many sectors and many industries in America, but also Europe sort of renewed under the cloak of COVID, if you like, enthusiasm for national champions and loss of appetite for competition policy. How big a role does concentration play in inequality, and how important is it to have a much more stringent competition policy, both sides of the Atlantic, each of you? And Thomas, if you could incorporate your answer into criticisms of your book from people like Raghuram Rajan, that you don't address that kind of thing.
That I don't address the role of very big economic player on inequality?
Of competition policy, from Raghu's review in the Financial Times, in fact.
Yeah, frankly, I don't know which part of the book he has read, but I certainly agree. Who could disagree about the fact that the very high concentration of corporate power in the big giant tech industries is playing a role, in the evolution of inequality. But I want to stress, it's competition policy, and the fact that the U.S. As a country, the U.S. federal government, never updated its competition policy to these new technology sectors, and the politics and ideology of it sort of did not adapt to this new world. I think partly also because of the international competition. I mean, you could see it also. Many U.S. presidents, whether Democrat or Republican, in the end feel that they have to protect their national giants, and so they don't want to do the kind of breakup and competition regulations that they should have been doing. But over and beyond the issue of antitrust, there's also the issue of taxation and having a fair playing field. We live in a world where the largest corporations, pay an effective tax rate that is often below what small and medium-sized companies are paying in their own country, and that's That's not good for the economy in general. That's not good for growth. That's not good for equality, and that's not good for the sense of fairness that we need for people, to be okay with the economic system and globalization. So this is something that will have to change, without breaking everything if possible. But at this stage, I see so many people who want to return to business as usual right away, that there's a risk that again the only discourse that happens, that appears to be new as compared to the business as usual, pro-market, pro-business discourse, is the kind of nationalist discourse that we've seen, taken over US and British politics and also European politics lately. And there's a risk that this crisis, in the end, on the one hand, it's going to reinforce the legitimacy of, say, public health spending, public hospital, but on the other hand, it's also going to reinforce for some people, the call to close frontiers, to close borders as the only, solution to regulate global capitalism. So, if you look at pandemics in the past, big pandemics in the past, I refer to that a little bit at the beginning of my book. If you look at the Black Death episode, it led to very different outcomes also in different parts of the world. For a long time, some economists believe the Black Death led to the end of serfdom and somehow more equality. But in fact, in some other areas, like in Eastern Europe, it led to the reinforcement of serfdom. So, again, pure economic and technological factors do not determine a unique outcome. It depends on the balance of power between groups, which is not only material, but also intellectual and ideological in terms of what worldview of the economy people are promoting.
Thank you. Robert, competition policy?
Yeah, I think the role of antitrust policy, or the lack thereof, in looking at the evolution of inequality is vastly overstated. The point of antitrust policy is to protect the competitive process. And some very good research by Larry Katz and David Otter and others has provided compelling evidence, at least to me, that that the sort of superstars aspect that I talked about briefly in my introductory remarks plays out in the marketplace at the level of the firm as well, that the most successful firms in a number of industries are the ones that have had the greatest increase in total factor productivity. They've attracted the most talented and productive workers. And yes, that can affect the wage distribution, but that doesn't mean the conduct that led to that, which is mainly competition on the merits, is anti-competitive. It might be a social concern, but it doesn't mean that it falls within the rubric, if you will, of antitrust policy. There are other policies that can be addressed to that. Now, it's true that in many cases, firms do engage in anti-competitive conduct in violation of either Section 1 or Section 2 of the Sherman Act, are the main antitrust policies in the United States. And when that happens, we have the tools to enforce antitrust policy. So some might argue that we've moved away from enforcing it at the same level that we did before, but we have the tools, and the outcomes that we see are not, in my opinion, the outcomes that follow from massive violations of antitrust laws. They're the competitive process at work. And sometimes we don't like certain aspects of how the competitive process plays out. But again, I come back to that doesn't implicate antitrust policy.
Okay, so we've got about 10 or 11 minutes for questions for Q&A from people who are watching. And there's a very good one here from Adam Zabner. The United States is still dealing with the political and economic effects of bailing out the banks and not individuals from 2008. It seems like the same choice is being made this time. And I'm wondering what the effects of that will look like. I actually myself wrote about this the other day. A lot of good, timely, unlimited support from the Fed for big companies and for all kinds of debt holders. A pretty patchy and box checking exercise for small businesses and individuals, of course, getting late checks. It does seem to be asymmetric. If you were already doing well before the crisis, you're getting quick assistance. If you're one of the victims of the crisis, it's much slower if it comes at all. Who would like to answer that question?
Yeah, I can say a few words. I think after the 2008 financial crisis, the balance sheet of both the Federal Reserve, the European central banks, and the biggest central banks in the world has expanded to an extent and with a rapidity that people would not have expected before. And now, 12 years, so that was 2008. And now in 2020, the very large segments of the public opinion have now understood, how much has been done to sort of save the banks, save the financial sector. And I think, there is a big and growing and legitimate demand, to mobilize the same resources to fight the COVID and help, in some cases, government, invest in their health system, invest in the green transition, invest in transportation infrastructure. And, I think it's going to be very difficult to explain people, well, no, look, in Europe, the balance sheet of the central bank has increased from 10 to 40% of GDP between 2008 and 2018. And I think, today there's going to be a very large demand, to use some of this, this possibility to raise resources, to do other kinds of investment. And I think, things are changing, just, if you actually today, and there was also some new announcement today by France and Germany to have a new plans to raise some common debt. And I think many things which looked impossible, could change because of this crisis. Again, I think it's very risky if we just do the same as what we did after 2008, which is in effect to boost the stock market and to boost real estate prices by the monetary injections that we put in order to stabilize, financial markets. That's going to be very difficult. Many people, in the large segments of the public opinion will really feel very negative about this, and I think that will be, very, very risky strategy.
Okay, thanks. Robert, do you want to briefly answer that, or shall I? There are plenty of other questions.
Why don't you go to the next question?
Yeah, okay. So from Serge Ramin, interesting question. Given the fact that we're likely to have L-shaped recoveries here in the West, do we expect COVID-19 is going to accelerate the center of gravity from west to east?
I would be surprised if that were the case. If anything, I think there's less cooperation or more suspicion between West and East. So this may play out, especially with regard to China. This might play out as very damaging to China in terms of Western perceptions, whether those perceptions are accurate or not.
So Carl Bushman asks, he says, Matthew Klein of Barron's argues that trade wars are coming thanks to the coronavirus, and partly linking into your answer just now, Robert. To fix this or forestall these trade wars, should we close the wealth gap?
I think we should use the threat of trade sanctions in order to move in the direction of more cooperation. So just to take an example, if you believe you should have a corporate tax rate of 30% and you're trading with a country that has 0%, the question is, what do you do? And I think, one possibility is to say, well, look, the companies that are based in the 0% country, in effect, they have a tax deficit of equivalent to 30% of their profit. So when they export goods and services to me, okay, they can do that, but I'm going to charge them this tax deficit. Now, the difference with the usual kind of tariff is that in case the government of country B raises their corporate tax rate up to 30%, then in effect, the tariff will disappear. So it's a very different from a standard kind of tariff where you want to have, tariff as such. Here the purpose, will be to try to raise incentives in order so that countries actually have an incentive to try to cooperate, and especially regarding tax dumping or social dumping, or it can also apply to environmental protection with carbon tax on exports coming from very high carbon emission countries. But I think we have to move away from this view that either it's a 0% tariff everywhere, with no exception, which is a bit crazy, because at the very least, you have some extra carbon emission coming from the international transportation. So at the very least, it should be taxed a little bit if we care about carbon emission. So it's a little bit like the religion of property in the 19th century. You want to stay at 0% because you're afraid that if you move away from there, you will not where to stop. Which I can understand, but it's a bit nihilistic. And I think we have to build some new narrative and some new set of principles so that we actually know where to stop, and we do this kind of trade sanctions, with a purpose tied to building a more equitable tax system, being a more sustainable future in terms of carbon emission. So we need to tie our trade policy to this specific social and environmental objective.
Robert, did you want to pick that up, or shall I ask the next one?
I'll just say that the connection between should we close the wealth gap and trade wars basically it escapes me. There are many reasons why we might want to reduce inequality in wealth, and then the next question was, how should you do it? Through redistribution or through efforts to increase people's ability to acquire human capital and save and things like that. But tying it to trade wars doesn't seem to me to be a good idea. It's that it comes back to that never waste a crisis kind of mentality that I mentioned earlier.
I think, to be fair, Danny Roderick and others have written quite a lot about how when there's great inequality and job losses, globalization tends to be scapegoated. So I don't think it's from...
That's certainly true. That's certainly true.
Let me ask you another one, though. And Robert, let me just direct this at you, but Thomas can pick it up. Yang Jiang asks, how does the recent rise in stock prices in the stock market, in the midst of all this sort of general macro despair, how do you explain that? What are the stock markets seeing that the rest of us aren't?
Well, if I knew a precise answer, I'd be richer than I am now, because I'd understand the way that's gone. I'm less optimistic than the market appears to be, certainly. But we always have to keep in mind that the stock market, the returns on shares, are the expected present value of future profitability. So they're seeing evidently a brighter future than many of us are seeing. The immediate circumstances affect immediate returns, but a stock price embeds the entire future of returns. And so, things can be going bad today and the stock market can be going up. I rarely borrow from Paul Krugman, but he has a chant that he uses sometimes that says, the stock market is not the economy, the stock market is not the economy, the stock market is not the economy. And so I'll say, the stock market is not the economy.
Message received. Unfortunately, we've only got a minute or two left, and so I'm going to ask what will probably be the concluding question to Thomas, or rather ask somebody else's. From Nicola Lassetera, I'm not quite sure if I'm pronouncing correctly. It's a good esoteric continental intellectual kind of question, so you might appreciate it, Thomas. Would Professor Piketty think of himself as more of a Gramscian than a Marxian because of his stress on cultural and ideological factors? Are you more of a Gramscian?
Yes, I don't know. I'm doing. I guess the difference with author like Marx or Gramsci is that what I'm doing is very data intensive. Also because it's not that they didn't have the idea of collecting data. It's because it's much easier today to collect data. So what I do in my work is first to try to quantify, the long-run evolution of inequality across, several dozen countries. Now in the World Inequality Database, we cover, most of the world. And what's new in this book is that I've also tried to collect data on ideology and in particular electorate. I try to answer a simple question: who votes for which political platform and political parties, and why has this changed over time? And I compare not only US, Western European democracies, but also India, Brazil. And I think it's important because all the discussion we're having, like for instance in the US, about how the Democratic Party has lost touch with the working class, are so much US centered. I think, and it's a big problem with discussion in the US, if I may, in general. And I think, there's a lot to learn by comparing many different countries together, and to see that some evolution, which we see as typically, US, you can find the same in countries that didn't have at all, say, the civil rights movement in the US in the 60s. So you need for better explanation. And so, I'm more Gramscian in the sense that I put more emphasis of ideology in, if you want, but the way I do it, is so much more based on sort of quantitative social science that it's hard to compare to this former and previous authors.
Well, Gramsci famously said, pessimism of the intellect, optimism of the will. Let's optimistically hope that there will physically be a conference next year in Chicago at the Stigler Center. In terms of this session this year, thank you very much to both of you. We covered a lot of ground, a lot of quite dense ground, and I learned a lot. So thank you very much to you, to Luigi Zingale, Simone, Sebastian, and the Stigler Center, and enjoy the rest of your day.
Thank you. Thank you all.
Thank you.
Bye-bye.
Bye-bye. Thank you.